And good morning and welcome to yet another little conversation, a fireside chat. Although I don't think we need a fire because we're speaking today with Avichai David from More Global Markets based in Tel Aviv in Israel. So you don't need a fire over there. It's probably warm enough for you. Good morning to you, Avichai. How are you?
Morning, Stuart. Thank you so much for having me on. It's a pleasure.
It's a pleasure to have you on as well. We've spoken a few times over recent months. I think we first met probably a couple of years ago, beginning of lockdown. For our viewer, would you like to give a quick introduction to More Global Markets?
Sure. So as you said, More Global Markets is based in Israel. It's a TPM service, TPM third-party marketer. We represent a variety of leading global managers from around the world in three main areas, being ETFs, mutual funds, and e-liquid, the whole alternative world, so private equity, real estate, infrastructure, and debt. We are owned by, MGM is owned by More Investment House, which is a traded company in Israel, regulated. There's about 250 employees at More Investment House, and so it's a pleasure to have them as our backers vis-a-vis the world.
Wow, I think you're probably the first TPM that I've come across that is owned by a listed company. How long have you been around as a business?
So as a business, we've been around going on 3 years now, about 2.5 years.
Right.
The first year being a COVID year, so it was a bit of a wash. But aside from that, we've been around about 2.5 years. And I've been in the business going on 12 years now. So I know the TPM business side of things quite well. I know the global markets, partners-wise, and I know the clients in Israel. So that combination is what constitutes the heart of the business.
Okay. Now, obviously, covering Israel, and that's a relatively new market for, certainly for me, from my knowledge within that region. Obviously, investment managers are looking globally these days, be it from the US, from Asia, from Europe. Coming into somewhere like Israel, what do you see as the biggest challenge for investment managers, as you see it?
So there's a few challenges. The managers that came into Israel 10 years ago, 12 years ago, on the one hand, had the challenge of Israel not being sophisticated enough. Even institutional investors were very much focused on Israel and outside of Israel, very much on the main markets. That was a challenge, but at least there weren't too many players around. Now, the institutional investors do everything. They invest more around the world than they invest in Israel. But now the market is saturated with global managers. It's very tough to sort of find your spot. And so we believe, it sounds a bit biased, but we believe that you're better with a TPM, somebody local, sort of boots on the ground, than to try to find your way amongst so many other players that try to approach institutions. We're about, let's call it 15 in number, right? There's others, but the top 15 are your bread and butter.
Yeah.
And it's tough. It's tough.
I think that's probably true for many markets these days. There is an oversupply, isn't there, of fund managers. I think you do need that local knowledge. I think that's critical. But when an investment manager is looking at Israel, what are the classic do's and don'ts for that market? What should fund managers be aware of?
I think they should take a hard look at their own offering. And first of all, decide if it's sellable. I know it sounds trivial, but it isn't, because sometimes we would look at funds and say this is not sellable. I don't know about Israel, but even around the world, we don't think it can sell. And Israel, it's got its own parameters, which we can discuss. But I think the biggest thing managers need to be ready for is this long-term view, not to expect stuff to happen in 6 months. This friction, it takes time. Again, because the market is saturated, because there's many players around the world as is, and most of them are in Israel already. Fees are an issue, and so anybody that is an active manager has a hard time versus ETFs. So, but in a nutshell, the biggest thing to be ready for is that it's going to take time.
Yeah. Okay. It's interesting. You touched on a couple of things there, and we'll probably touch on them later on, particularly around the fee issues. But when you're looking at a fund manager, like ourselves, and we review a fund manager, there's lots of different things, almost like a not a box ticking exercise, but there's certain criteria that we want for them to meet before we'll onboard them onto our funds platform and the management company there in Dublin. But when you're looking at an investment manager, what are the criteria that you're looking for, which helps you make the positive decision?
So it's a variety of things. There's a bit of an art behind picking the right partners. There's also an art behind selling the partners' products.
Yeah.
But it's a mix of obviously results, how long the results are good for, so the track record. Obviously, we check whether the current PM has been the PM for the past, let's say, 5 to 7 years. Some funds were launched in 1989, but we assume it's not the same manager any longer. We need the manager to be committed to coming to Israel, because these institutions will want to speak to them, pick their brains, understand what the philosophy is all about. Forget the headline for a second. This is a value fund, fine, but they want to dig in, and for that, they almost never want to speak to a product specialist. They want to speak to the PM himself or herself. And obviously, we need a contract to be viable. This cannot be a short-term contract. And at the end of the day, we need to get paid as well. So this combination of things is what we look at, maybe even in this order. So results, commitment, philosophy, and then the contract, which the manager is willing to offer.
Okay. Let me just touch on that point there about the commitment. I mean, there's that time commitment. Obviously, we're having a conversation here on Zoom, and we've all got used to that in the last 2 years. But I think I'm picking up from you that you still have to get in front of them. They want to see the color of your eyes. They want to, how often should an investment manager consider coming, getting on a plane and coming into Israel?
Yeah. So look, I think Zoom has changed the world maybe forever, and what was not relevant in the past is certainly quite relevant today. I mean, we do many Zoom calls, and this is to replace face-to-face meetings, and that way too the PM can speak to clients more often than before. Mm-hmm. I think that now that we're out of COVID, I think once a year is what the PM should look at as the commitment. And sometimes, clients wanting to speak to a PM is a good thing. It's not a bad thing, and it's a marketing tool as well. Yeah.
So other times around that, other than just the visits, I guess webinars and seminars and conferences, I guess if there's a local conference coming for that.
Sure, and maybe at the beginning, but as the clients get to know the PM, they understand the philosophy and they understand why the fund is up or down and what it does. Yeah. The visits and the calls become less frequent. Yeah. But at the beginning, there may be 2 or 3 calls to get to know the PM.
That's right. Just going back on something you said earlier on as well, which is about the fees. We've seen a huge pressure on margins, which is feeding through into the fees. I mean, having a fund these days is not cheap. I say that to any fund manager. You think about launching a cheap fund, good luck on that. And you mentioned something about ETFs there. Were you talking about passives or active? Because because some recent research we've done is the active ETF market is just as expensive as the active UCITS space. Are you seeing differences?
Absolutely. The active ETFs are mutual funds, basically wrapped as an ETF, and those are expensive. When I'm referring to ETFs, I'm more talking about the plain vanilla passive, right, which you can buy for nearly zero. Obviously, EM and China and all that are more expensive than, say, an S&P ETF. But when I say ETFs, I'm talking about the passive, not ETF.
So what do you feel a manager coming into Israel should be selling their fund at? In the past, retrocessions meant the fees were pretty high. Now retrocessions are pretty well gone, I guess. Are there still some rebates that need to be paid to distributors?
I guess it depends on what the headline fee is, right? And it changes from category to category.
Sure.
What
would global equities go? Just taking that as an example, global equities into that space. What would you expect?
I think global equities, you're looking at a management fee of about 0.6 or 0.65 around there. This is not TER. This is
No.
TER is another 15 basis points. Around there, it could vary from 0.55 to 0.75.
Yeah.
High yield is around 0.45. Around there. Some are cheaper too. Investment grade is very cheap. It's 0.2, 0.25, 0.3. It's something that Israelis now don't invest in because of a regulation that we can discuss. But that's probably the cheapest.
Right. Okay. So that's very competitive pricing, isn't it? Certainly compared to, say, the UK, European market, global equities going out about 65 to 75, 80, credits going out around about 45 to 55. So yeah, you're pretty tight.
But again, I think those are headline numbers. I think when an institution, we can discuss the size of the institutions here, but when an institution comes to invest $100 or $150 million, they often don't pay the headline number, unless it's very low to begin with, and that's fine.
Yeah, no, I would agree with that. Obviously, we touched on sort of credit and global equities, which are pretty generic products out there in the market. What have you found has been the biggest seller in the market so far this year? What's hot at the moment?
Yeah, it's funny. People ask that. I think, again, going back to the sophistication of the market, I think there's no hot topic anymore. They're invested across the board. They follow the MSCI and they follow the bond indices. They invest in, on the alternative side, private equity, infrastructure, real estate. They invest across the board. I think growth is a bit out of favor, and value is where they're looking for value. We think now is a bit late. I mean, if you weren't in value a few months ago, now is a bit late to look into that, and it's a bit late to sell growth. But who knows, right? We as a TPM don't believe in timing any sector, and indeed we don't sell timing advice. The clients come to us and say, we're looking for such and such a category. Do you have an ETF or a fund that is competitive? And that's where we come in.
Okay.
We'll never say we think China is now good or the US is not. We're not there.
No, you're just positioning the fund relative to its competitors, or as a new idea, I guess. You're not giving market intelligence.
No, we'll explain the philosophy. We'll set up the PM meetings. If there's questions around the fund positions and why not, we're there. But not market time.
And when it comes to new launches, new funds coming into the marketplace, obviously the size of the fund is quite important, I presume. The AUM is really quite important. What sort of initial investment would you expect for a fund to come into that market, to be of a size? What would you expect?
So you're talking about a first-time fund that is just sort of putting itself together?
Yeah.
I think it's nearly impossible in Israel. I think the only time it is possible is if there's a let's say a U.S. onshore fund, and they come to you and you guys together set up a UCITS version. Then the client can rely on the track record going back on the onshore and be part of the seeding of the UCITS version. Even that is quite tough because they're not allowed to be more than a certain percentage in any fund.
Mm-hmm.
And so some will look at the manager as a manager, will say, fine, I'll be 20% of the manager, not the UCITS fund. But often it's the fund itself, and that very much limits how much they can invest.
Yeah.
So what we've done in the past and others do is they'll sort of they'll get 5 or 6 or 7 investors together, each investing, let's say 10 or 20 million. They'll rely on you as well to bring clients in, and together now the fund is 200 or 300 million, and that gives you room to invest.
Yeah.
But it's difficult. This timing is difficult, and by the time you set it up, the market could be gone already.
Yeah.
So it's not as intuitive as it sounds.
It's difficult. I mean, seed investors. I was talking with somebody recently about this, and the seed investors pretty well disappeared. They seem to have run to the hills in recent years.
And it's again, I think, because fees are so low to begin with. This temptation of well, let me lower the fees for you. You know, it's not really there anymore because fees are low as is. So why should they go into a seed fund? Unless it's very specialized, relying on some incredible onshore fund, fine. But otherwise, there's no interest.
Yeah. Just one final question, which just sort of just come to me, Avi. But the structure of the Israeli market is it similar to other markets in the sense you've got the institutional clients, you've got wealth managers, you've got financial advisors? Just a very brief outline of that.
So the financial advisory market is not really existent in Israel. You've got institutions, which are pension funds and insurance companies. Those are sort of the long-term, that's a long-term money that manages about $700 billion.
Right.
Then around that, you've got a bunch of smaller managers, smaller insurance, smaller pension. And below that, you've got the family offices, which have grown tremendously in number and in assets. That's a market that we view as a sort of tier 2, and we only take it on if it's complementary to the tier 1. But we won't just take on the family offices as a target. It's not enough money for us. There's not enough interest.
Yeah. Okay. Avi, this has been a great little introduction to the Israel market. I really appreciate your time. I'm sure our listener will enjoy watching this. I look forward to catching up with you another time. And as I said to you before, I look forward to coming to Israel and a meeting with you face to face, and rather than these Zoom calls. So for now,
that would be my pleasure. I think you'll find the Israeli market very sophisticated and on par with the rest of the world. So you'll have a good time, I think.
I look forward to it. For now, thank you so much, and we'll speak to you soon. Bye-bye now.
Thank you, Stuart. Thank you.